Have you ever actually measured how much of your life is being exchanged for money? Most people do not. They feel busy, they feel tired, they feel pressured, but they rarely sit down and calculate the machine they are living inside. Suppose you wake up at 7 in the morning, you spend an hour getting ready and getting to work. You work 8 hours, then you spend another hour getting home. That is 10 hours of your day organized around earning money. 10 hours every weekday. You give time, attention, energy, patience, and health to earn the paycheck. But then ask the opposite question. What is your money doing for you? For many people, the answer is almost nothing. It sits in a bank account, earning barely 1%. It waits, it sleeps. It loses purchasing power while prices rise around it. You are working all day, but your money is lying still. That is not a balanced system. That is a system where labor does all the work and capital does almost none of it. And if you stay in that system long enough, you will always feel behind because labor has limits. You only have so many hours, you only have so much energy, you only have so many years. But capital, if placed correctly, can work every hour of the day. It can work while you sleep. It can work while you spend time with family. It can work while you rest. It can work while you are on vacation. It can work during years when you are too tired to push harder. That is why the central idea is so important. Make your money work for you instead of always chasing after money. Now, most people panic when they hear the word investing. They imagine sitting in front of 6 screens watching candles move. They imagine guessing the next hot stock. They imagine losing everything in one bad morning. They imagine stress. But if your investment system keeps you awake at night, that is not financial planning. That is self-inflicted pressure. A proper asset allocation system should feel more like setting a washing machine. You choose the cycle, you add the clothes, you press start, then you go live your life. You do not stand in front of the machine for the next hour worrying about every rotation of the drum. Investing should work the same way for most ordinary people. You design the system, you automate the behavior, you rebalance periodically, then you let time do the heavy lifting. This is not day trading, this is not chasing, this is not trying to beat every professional in the market. This is using structure to keep your money productive without turning your life into a daily stock market obsession. The starting number in the source is $10,000. That matters, not because $10,000 is enough to make you rich overnight, it is not. It matters because $10,000 is psychological threshold when you have $10,000 and you leave it sitting in the bank. The mistake becomes visible. You can feel that the money could be doing more. You can see that it is large enough to matter, but not so large that you need a private banker to manage it. It is the perfect point to build a system. If you had $10,000 right now, what would you do with it? Would you leave it in a checking account? Would you put it in a low-yield savings account? Would you lock it into a fixed deposit? Would you buy an insurance savings product without fully understanding the return? Or would you build an allocation that gives your money different jobs? This is the question. Most people work hard for years to collect cash, then allow the cash to sit somewhere earning almost nothing. They feel responsible because they save. But saving is only the first step. Saving creates the raw material. Allocation decides what that raw material becomes. Cash without a job is vulnerable. Inflation is the hole in the bucket. You can carry water up the mountain for years. But if the bucket leaks, you do not arrive with what you thought you had. That is what inflation does. It reduces the purchasing power of money that is not growing fast enough. This is why the first myth must be broken. The myth is that investing is dangerous and saving is safe. That sounds reasonable. Cash feels safe because the number does not move. You open the account and the dollars are still there. No red candles, no market swings, no headlines about crashes. But safety has to be measured in purchasing power, not just in account balance. If inflation is around 3.3% and a one-year bank yield is around 1.9%, then the cash is not really safe. It is shrinking in real terms by about 1.4% a year. The account number may be stable, the life that number can buy is declining. Over 10 years, the purchasing power of $10,000 can fall to around $8,700 under that kind of gap. The bank did not steal the money, the price level did. That is why cash can be safe in nominal terms and unsafe in real terms. Nominal safety means the dollar amount stays visible. Real safety means the purchasing power is preserved. You need cash for emergencies. You need liquidity, you need reserves. But if all of your money sits in low yield cash forever, inflation slowly eats it. This is the first principle. Saving protects you from short-term chaos. Investing protects you from long-term erosion. You need both. The second myth is that you need a lot of money to start investing. People say, I will invest when I have $50,000. I will invest when I have $100,000. I will invest when life feels stable. I will invest when I understand everything. That thinking delays the most valuable part of the process. Building the system. $10,000 is enough to start. Even less can be enough to start if the habit is correct. The amount matters less than the structure. This is like going to the gym. You do not refuse to exercise because you are not strong yet. You start with lighter weights because the purpose is to build form, rhythm, and identity. Investing works the same way. You do not wait until you are wealthy to behave like an owner. You behave like an owner so that wealth can begin to form. The first $10,000 teaches you how to allocate, how to automate, how to tolerate volatility, how to rebalance, how to avoid panic, how to think in decades instead of days. That education is worth more than people realize. The third myth is that investing means spending your life studying charts and individual stocks. That may be true for professional traders or analysts. But most people with jobs, families, and real responsibilities do not need to live that way. In fact, trying to live that way can make them worse investors. If you work 9 to 5, your time is valuable. You may be better off using extra hours to increase your income, improve your skills, build relationships, or rest properly than trying to outguess the market every night. The core of passive investing is humility. You are admitting that the market is a very complex machine made of millions of participants, information flows, incentives, and expectations. Instead of trying to beat it every week, you choose to own it broadly. You do not have to predict every winner. You do not have to forecast every rate move. You do not have to trade every headline. You build a portfolio that captures long-term growth and manages risk. That is a much better fit for most people. Now, why does $10,000 create such a psychological shift? Because at 6%, $10,000 can generate about $600 a year. That is about $50 a month. $50 a month does not make you financially free, but it is the first time many people can feel money producing money. The income arrives whether you were working that hour or not. That matters. The first automatic dividend, the first interest payment from a meaningful balance. The first month when your account grows without your labor changes the way you see money. It teaches you that income does not have to come only from your body and your time. It can come from ownership. This is the psychological beginning of financial freedom. The money is still small, but the concept is huge. A tree is not impressive when it is just a seedling. But if you understand trees, you know the seedling is not nothing. It is the beginning of future fruit. That is how the first $10,000 should be viewed, not as the finish line, as the first living tree. Now, if asset allocation is simple, why do most people still fail? Because they lack a system. They watch one video and buy one stock. They hear one friend mention one fund and copy it. They see a market dip and panic. They see a market rally and chase. They put money in once, then stop for months. They act in bursts. That is not a system. It is impulse. Impulse rarely builds wealth because impulse depends on mood. A system does not depend on mood. That is why the source divides the $10,000 into 3 layers. The safety net, the growth engine, the opportunity bullets. This is a simple structure, but it is powerful because each dollar has a job. This is one of the deepest principles in financial planning. Every dollar needs a job. Some dollars protect you. Some dollars grow for you. Some dollars wait for opportunity. If you do not assign jobs, money drifts, it sits too long, gets spent casually, or enters the market at the wrong time because emotion takes over. The first layer is the safety net. 20% of the $10,000 or $2,000 stays as emergency cash. This is not investment money. This money does not need to impress you. It does not need to chase maximum return. It needs to be available. A high-yield checking account, high-yield savings account, savings plan, short-term fixed deposit, money market fund, or other safe liquid vehicle may serve this purpose depending on your country, institution, and risk. The point is liquidity and stability. Some people look at this $2,000 and say, why not invest at all? That sounds smart until life happens. A pipe bursts, a car breaks, a job is lost, a medical bill appears, a family emergency hits. If all your money is invested and the market is down, you may be forced to sell at the worst possible time. That is one of the most common ways people fail at investing. They do not fail because their assets were wrong. They fail because they had no cash buffer. When an emergency came, they had to liquidate long-term assets for short-term survival. That breaks the system. The safety net prevents that. It gives you psychological security. It allows the growth portion to remain invested. It lets you think clearly during market volatility. This is why cash is not always idle. Cash can be emotional infrastructure. It helps you hold the risky assets long enough for them to work. Without cash, even a good investment plan can become fragile. Think of it like running a marathon. If you sprint at the beginning and use every bit of energy, you may collapse before the race matters. The safety net keeps your pace controlled. It is not the fastest part of the portfolio. It is the part that keeps you in the race. The second layer is the growth engine. This is 60% of the $10,000 or $6,000. This is the core capital designed for long-term growth. The source puts this money into a mix of broad stock ETFs and bond ETFs. Specifically, it uses a 70-30th split inside the growth engine. 70% of the growth engine goes into broad stock market ETFs such as VTVO or VTI. 30% goes into bond ETFs or investment grade corporate bonds. The principle is simple. Stocks provide growth, bonds provide stability. Stocks are ownership in businesses. Over long periods, stocks have historically produced higher returns because businesses grow, earn profits, reinvest, innovate, and distribute cash. But stocks are volatile. They can fall sharply. They can remain down for painful periods. Bonds are different. They usually provide lower returns, but they can help stabilize the portfolio. In some downturns, high-quality bonds may hold up better or even rise when stocks fall. They can reduce the emotional pressure of holding equities. This is not guaranteed in every environment. In inflationary periods, both stocks and bonds can struggle, but over many market cycles, combining the two can create a smoother ride than stocks alone. The goal is not to eliminate volatility. The goal is to make volatility survivable. That matters because most investors do not fail from lack of return. They fail from lack of endurance. A portfolio that is too aggressive may produce high expected returns, but if the investor cannot hold it during a crash, the expected return is useless. The right portfolio is not the one that looks best in a historical chart. It is the one you can actually hold. That is why the 70-30th structure is useful. It keeps the portfolio growth oriented but not entirely exposed to stock volatility. Now, the source makes another important point. Do not obsess over buying at the absolute bottom. Market timing is almost impossible to do consistently. Even professionals with teams, data, and research fail at it. Ordinary investors trying to guess exact bottoms often make emotional decisions. They wait for a crash. Then the crash comes and they are too afraid to buy. Or they buy a little, the market falls more and they panic, or they wait for more downside. But the market recovers without them. This is why dollar cost averaging is so useful. Instead of putting all $6,000 into the market at once, the source divides it over 6 months, investing $1,000 per month. This reduces the emotional risk of entering at exactly the wrong moment. If the market goes down during the 6 months later, purchases happen at lower prices. If the market goes up, at least some money was invested early and participates. This is not perfect. No timing method is perfect, but it removes the pressure of making one giant decision on one day. Most people benefit from reducing pressure. The more pressure on a decision, the more emotion enters. The more emotion enters, the easier it is to make mistakes. Averaging and creates a system. The third layer is opportunity bullets. This is the final 20% or $2,000. This money is flexible. It is held back for clear market dips. This is not emergency cash. The emergency cash is separate. This is investment ammunition. The source S rule is simple. When the broad market drops more than 15% from its peak, begin deploying this money in batches. That is a useful rule because it removes guesswork. Without a rule, people say, I will buy the dip. Then the dip comes and they hesitate. Is it down enough? Will it fall more? Is this a recession? Should I wait? A rule gives you instructions before the emotion arrives. That is the value of rules. A good investing rule is made in calm conditions and used in emotional conditions. Now, what if the market keeps going up and the $2,000 is not deployed? That is a trade-off. The opportunity cash may underperform the market during a strong bull run, but it can sit in a money market fund or short-term instrument earning 2 to 3% depending on the environment. It is not completely asleep. More importantly, it gives you psychological strength. When the market falls and others panic, you are not only afraid, you have cash prepared. That changes your mindset. A crash becomes not only a threat, but also an opportunity. This is why dry powder matters. Dry powder is not only money, it is emotional power in 2022. The source describes using opportunity cash during the market decline. Many people were panicking, but the prepared investor could deploy capital at lower prices and benefit when the market rebounded in 2023. This is the way cycles should work for you. Most people sell into fear. Prepared investors buy into fear. The difference is not bravery alone. The difference is preparation. You cannot buy a crash if all your money is already spent. You cannot buy a crash if you have no cash. You cannot buy a crash if you have no rule. You cannot buy a crash if you never mentally prepared for volatility. Opportunity bullets solve part of that. Now, the structure is clear. $2,000 safety net, $6,000 growth engine, $2,000 opportunity bullets. The safety net protects you from life. The growth engine builds long-term wealth. The opportunity bullets let you take advantage of market fear. That is a balanced system, not all cash, not all stocks, not all bonds, not all speculation, different dollars doing different jobs. This is how I like to think about it. A financial system fails when every dollar is asked to do the same thing. If every dollar is cash, inflation hurts you. If every dollar is invested, emergencies can force bad sales. If every dollar is growth stock, volatility can break you. If every dollar is bonds, long-term growth may be too slow. If every dollar is waiting for a dip, you may miss years of gains. A robust system assigns different roles. That is why the 20 divided by 60 divided by 20 structure works as a teaching model. Now, how do you actually execute it? The first step is to open a brokerage account. This used to feel difficult. Today, it is usually straightforward. Most major brokerage platforms allow you to open an account online with identification and bank details. The process may take minutes. When choosing a broker, focus on reliability, low fees, user-friendly interface, available products, account protections, and ease of automation. Many major brokers offer zero-commission ETF trading, but always check the details. Do not choose a broker because of a flashy app alone. Choose a platform that helps you behave well. A bad platform encourages gambling. A good platform supports long-term investing. The second step is to set up automatic transfers. This is crucial because human beings are not naturally consistent. If every month you have to log in, think about the market, and manually decide to invest, you will eventually find a reason not to do it. You will be tired, the market will look expensive, the market will look scary, a bill will appear, you will tell yourself you will do it next week. Then next week becomes next month. Automation protects you from yourself. If $1,000 per month is part of the plan for 6 months, automate the transfer. Let the system act when the paycheck arrives. Do not leave it to mood. After a while, the transfer becomes normal. You stop treating it as optional. This is how wealth building becomes automatic. The third step is to pick the ETFs. The source suggests broad market funds like VTI, VO, and VT. VTI gives broad exposure to the U.S. stock market. VO tracks the S&P 500, giving exposure to large U.S. companies. VT gives global stock exposure, including the United States and international markets. Each has a role. If you want the simplest U.S.-focused approach, Vermont I or VU can be reasonable. If you want global diversification, Vermont may be more appropriate. There is no perfect fund. There is suitability. This matters because people waste enormous time trying to identify the absolute best ETF. They compare tiny differences and delay action. The cost of waiting can be larger than the benefit of choosing a slightly better fund. The first goal is to start with a sensible, diversified, low-cost vehicle. You can improve later. You do not need perfection before beginning. For bonds, investors might use broad bond ETFs, government bond ETFs, or investment-grade corporate bond funds depending on risk tolerance, interest rate sensitivity, and account type. Bonds are not all the same. Duration matters, credit quality matters, inflation matters. But for a simple allocation, the purpose is stability. The fourth step is rebalancing. Rebalancing means returning the portfolio to its target allocation after market movements. Suppose your target is 70% stocks and 30% bonds inside the growth engine. Over a year, stocks perform well and grow to 80% of the portfolio, bonds fall to 20%. Now the portfolio is riskier than you intended. Rebalancing means selling some of the winner or directing new money toward the lagging asset so the portfolio returns to 70 divided by 30. This feels counterintuitive. People do not like selling winners and buying laggards. But rebalancing is the mechanism that forces discipline. It makes you trim what has run ahead and add to what is relatively cheaper. Sell high. Buy low, not emotionally, mechanically. The source suggests doing this once every 6 months. That is often enough for a simple portfolio. It is not too frequent, but it keeps the system from drifting too far. Rebalancing may have tax consequences in taxable accounts, so sometimes using new contributions to rebalance is preferable in tax-advantaged accounts. It may be easier. Again, details matter, but the principle is the same. A portfolio without rebalancing can become a different portfolio without you noticing. The fifth step is to keep learning without overreacting. This is one of the hardest balances in investing you should learn. You should understand markets, interest rates, inflation, asset classes, taxes, and portfolio construction. Ignorance is not a strategy, but learning does not mean changing the plan every week. Many retail investors underperform market indexes by several percentage points because they trade too much, chase trends, panic during declines, and react emotionally to news. The source gives a 3 to 5% underperformance range, which reflects the broad truth that behavior can destroy returns. A good plan is usually boring, buy, hold. Rebalance, keep adding, improve your income, avoid panic. That is not exciting, but it is powerful. The best financial plans often feel too boring to share. That is why they work. Now, what return can this system reasonably expect? The source uses a historical 70 divided by 30 stock bond portfolio return around 6 to 8% annualized, and it frames that as a real long-term return after inflation. The exact return depends on the period, valuation, bond yields, inflation, fees, and taxes. It is not guaranteed, but the illustration is useful. If $10,000 compounds at 7%, it grows to nearly $20,000 in 10 years. In 20 years, it grows to over $38,000 in 30 years. It grows to over $76,000, that is with no additional contributions. Now add $200 per month. Over 30 years, the total can grow to over $300,000 under the source as assumptions. That is the power of the system. The initial $10,000 is important, but the recurring contribution is what turns the system into a serious wealth-building machine. This is why people should not think only about lump sums. The initial amount starts the engine. Monthly contributions keep feeding it. A person who invests $10,000 once and stops can still do well. A person who invests $10,000 and then adds $200 every month can build something much larger. Small monthly money becomes enormous when given 30 years. That is compounding. Now, we must be honest about the path. There will be market crashes. The account will fall. Sometimes it will fall sharply. During the COVID crash in March 2020, many portfolios fell more than 30%. That felt terrible. The source describes the account dropping by over 30% and the emotional discomfort of watching paper losses. That pain is real. But selling into that pain can be the mistake that destroys the plan. If the portfolio is properly allocated, the bond portion can help cushion the decline. The safety net can prevent forced selling. The opportunity bullets can allow buying into the decline. The system tells you what to do. That is why the system matters. Your biggest enemy is not usually the market. It is your own emotion. The market will move. Emotion tells you to do the wrong thing at the wrong time. Fear says sell after a crash. Greed says buy after a bubble. Impatience says change the plan because the result is slow. Overconfidence says abandon diversification. A system is designed to protect you from those impulses. When the market falls, the system says continue dollar cost averaging. When the market falls more than the chosen threshold, the system says deploy opportunity cash in batches. When one asset grows too large, the system says rebalance. When the plan feels boring, the system says keep going. This is how discipline replaces emotion. Now, one of the most important points in the source is that investing returns are not your only source of wealth. Your human capital is probably your largest asset. If you are 30 years old and earn $60,000 a year until age 65, that is $2.1 million of future gross income before raises. Your future earning power is enormous. If you can raise that income, the entire investing system becomes more powerful. This is where many investors get the order wrong. They spend all their mental energy trying to increase investment returns by 1% while ignoring the possibility of increasing their income by 50% or 100% over several years. If you can increase your salary from $60,000 to $120,000, your investment capacity changes dramatically. The source gives an example of a friend who started with $10,000 but also worked hard to improve professional skills. Over a few years, salary doubled from $60,000 to $120,000. Because income rose, annual investments rose too. By age 38, the portfolio exceeded $100,000 and kept growing. That is the complete system. Invest money. Invest in yourself, raise income, invest more money, the portfolio compounds, your skill set compounds together. They create acceleration. This is very important because passive investing is not an excuse to be passive in life. Your portfolio should be passive. Your self-development should not be. Human capital creates the cash flow that feeds financial capital. Financial capital eventually reduces dependence on human capital. That is the bridge. At first, your skills earn the money. Later, your money helps carry the load. Now, let us summarize the core structure in plain terms. Diversify risk, hold long-term, execute with discipline. With $10,000, hold $2,000 as the emergency safety net. Put $6,000 into the core growth portfolio using a reasonable mix of broad stock ETFs and bond ETFs. Keep $2,000 as flexible opportunity cash for meaningful market dips. Automate transfers. Use dollar cost averaging. Rebalance every 6 months. Keep learning, but do not overreact. This strategy will not make you rich tomorrow. That is not the promise. The promise is different. It gives you a real chance to build financial freedom over 10, 20, or 30 years without spending your life staring at charts. That is the correct promise. Slow wealth, durable wealth, low stress wealth, the kind of wealth that comes from structure rather than adrenaline. Now compare that to leaving $10,000 in the bank. If inflation continues, the purchasing power declines. The cash feels safe because the number does not move, but the real value slowly erodes. 10 years later, the money may buy less food, less gas, less healthcare, less housing, less everything. Inflation does not wait until you feel ready. That is an important sentence. The market will always feel uncertain. There will always be risk. There will always be a reason to wait. Elections, recessions, wars, interest rates, inflation, valuation worries, job uncertainty. If you wait for a world with no uncertainty, you will never start. The best time to invest was years ago. The second best time is when you can create a responsible system. Now that does not mean throw all your money blindly into the market. It means build the 3 layers: safety, growth, opportunity. Then act. Most people do not need more motivation. They need structure. A person can feel inspired for one day and do nothing. A system makes the action repeat after inspiration fades. That is why the next step should be simple. Look at what you have. List your assets, list your cash, list your debts. Decide what amount is safety net, decide what amount is growth engine, decide what amount is opportunity cash. Open the brokerage account if you need one. Set up automatic transfers. Choose sensible broad ETF schedule rebalancing. Then leave the system alone long enough to work. Do not wait until you feel perfectly ready. You will never feel perfectly ready. The market is never perfectly calm. The future is never perfectly certain. But action taken with a system is very different from reckless action. Reckless action says buy because you are excited. Systematic action says allocate because you understand the machine. That is the difference. Now let us think about the emotional reward. When you see your account begin to grow, something changes. Even if the amount is not huge, the feeling is different from wage income. Wage income depends on you working. Portfolio growth tells you that money has started to work too. That creates confidence, and confidence changes behavior. You may spend less carelessly because you want more capital working. You may avoid bad debt because you understand compounding. You may feel less desperate at work because you are building options. You may care more about skills because you see how income feeds investments. You may think more long-term because the account makes the future visible. This is the real meaning of financial management. It is not just becoming rich, it is creating the power of choice. Choice is the real asset, the choice to stay in a job because you want to. Not because you are trapped, the choice to handle emergencies without panic, the choice to help family, the choice to take a career risk, the choice to rest, the choice to say no, the choice to retire earlier or more comfortably. That is what money buys when used properly. Not just consumption options. Now let us be careful. A $10,000 system is not enough if the rest of your financial life is broken. If you have high interest debt, that must be addressed. If you have no cash at all, the safety net matters first. If your spending is larger than income, investing alone will not fix it. If you constantly raid your investment account, the system cannot compound. If you panic sell during crashes, the system breaks. So the plan requires behavior. The allocation is not magic. The allocation is a tool. The person must still follow it. This is why I would not tell someone to invest every dollar immediately. I would tell them to build the full structure cash for emergencies, core investments for growth, opportunity cash for crashes, automatic contributions, rebalancing, skill development. This is how you create a system that can survive life. Now, the biggest mistake after starting is checking too often. If you check the portfolio every day, you invite emotion into the process. Every red day becomes a threat. Every green day becomes temptation. The more often you look, the more noise you see. For a long-term system, monthly or quarterly review may be enough. Rebalance every 6 months if that is the rule. Learn for 1 or 2 hours a month. Stay informed but not obsessed. Your life is larger than your portfolio. The point of passive investing is to free your time, not steal it. If investing consumes every hour of your attention, it has failed its purpose. Now let us bring the whole idea back to the opening question. You spend 10 hours a day working for money. That may be necessary, but it should not be the only engine. Your money should not sleep in a bank forever while you age, work, stress, and watch inflation rise. The point of the $10,000 allocation is to wake the money up, not recklessly, systematically. 20% protects you, 60% grows, 20% waits for opportunity. That is a simple machine. If you keep feeding it and avoid breaking it, it can grow into something much larger than the starting number. At 7%, $10,000 alone can become more than $76,000 over 30 years. With $200 per month added, it can become more than $300,000 under the Source S assumptions. That is the lazy way only in one sense. It is lazy because you are not trading daily. It is not lazy in the deeper sense. It requires discipline. It requires patience. It requires resisting panic. It requires setting up the system. It requires letting boring work. Most people fail because they want excitement. Wealth usually rewards boredom. Buy, hold, rebalance. Keep learning, increase income, add monthly, use dips. Do not panic. That is the quiet path. And for many people, the quiet path is the only path that can actually be followed for decades. So if you have $10,000, do not let it rot. Do not gamble it. Do not freeze because you are scared. Do not wait for perfect certainty. Build the system, make your money work. Then keep working on yourself so you can feed the system more. In 10 years, you may thank yourself. In 20 years, you may barely recognize the size of the machine. In 30 years, the decision to begin may look like one of the most important choices you ever made. That is how financial freedom begins, not with noise, with a system.